The energy rally taking a bit of a pause today with the XLE ETF closing in the red, but still up nearly 40% so far this year. Take a look at this headline splashed across the Wall Street Journal today. It reads, "Sell Tesla, buy Exxon." Sounds kind of familiar, right, to all you loyal Fast Money fans? It should. Let's fire up the Fast Money time machine to a conversation we had with oil analyst Paul Sankey all the way back in August.
The 2000s, as you know, was a huge for oils, and we've had an absolute disaster in the past decade. The next decade is going to be great for these stocks. As for shorting Apple and buying Exxon here, I'll do it. I'll come back in 5 years and we'll see how we do.
We didn't have to wait 5 years. Paul's pair trade is working out. Apple far underperforming, Exxon since that call. So we checked back in with Paul in January, and he doubled down on his energy bet with a new pairs trade.
But, you know, I'm the analyst that tagged EOG, the Apple of oil, because of its technology. And so I was thinking, how can I get another trade like this going? So let's go long EOG, short Tesla. Let's do it.
Another home run call for Paul, in fact, is a perfect pairs trade. EOG is up 21% since that call. Tesla is down 20% since then. So let's bring in the man himself, Paul Sankey of Sankey Research. Paul, you got a hot hand. What do you want to declare next?
Well, you remember the second time around, I said, actually, I should have retired after the first call. So, you know, we got to keep going with this, I guess. There's a lot of cross currents right now. As you know, we've had a very big move. And when you see that Saudi attack on Sunday, you know, we really got stretched. We'd really got stretched on the relative strength. And oil was, you know, hitting 70 on Brent. It was ahead of itself, you know, so we're coming back a little bit here. And actually, if anything, I think the trade is refining. You know, what we like is the idea of getting long refining between here and driving season. The stocks are kind of expensive against terrible margins right now. But if anything works from February to May, it's going to be something like PBF or Marathon Petroleum or Valero. You know, these are the names perhaps to look at with oil having got so stretched. But having said that, the super cycle that we've talked about, the 5-year trade, is still on in oil.
Hey, Paul, it's Tim. So, yeah, congrats on.
Go ahead, Tim.
Go ahead. All right. So, Paul, yeah, I mean, stock picker extraordinaire. Congratulations on that. And you just started to get into the macro. It's important for anyone to understand supply-demand dynamics, and at least for that, you know, that devastating 5-year run, it was really about way too much supply. The OPEC Plus announcement of a week and a half ago has a lot to do with that rally that was faded by the disruption trade over the weekend. Give me your outlook on where we are on supply-demand and OPEC cohesion, and can traders trade along with that?
Right. So basically, we thought that the market believes that we're drawing about 1 to 2 million barrels a day undersupplied in the market. So the market is tightening for oil, and we haven't come back from COVID yet. Obviously, we're in March, early March, mid-March is a seasonally weak time. So we're expecting, like many others, obviously, to see the seasonal increase in demand. And you could see 1 million barrels a day every month now. Into May, June, and driving season. So that takes you from the 2 million I just mentioned, undersupplied, plus the 3 or 4 million of extra demand, to a market that's 6 million uptight, and probably about 5 to 6 million of OPEC spare capacity. So the market's looking very balanced here. What a lot of my clients and I wanted to see was actually OPEC increase, and how the market would take the additional oil that was originally planned. But we got this sort of juice, you know, call from Saudi, where they said they're going to extend the cuts. And so we didn't really test, you know, what's the underlying market here. So we weren't as thrilled as you would think by the Saudis not increasing again, because we really want to try and get back to an ex-OPEC market. You know, a lot of long-only investors, for example, don't want to be involved in a market that's dependent on OPEC. We want a real proper supply-demand balance. Having said all that, the balance looks like it will be very good into summer and beyond. And that's really the super cycle call, especially when you combine it with the whole Fed, you know, inflation trade.
Hey, Paul, it's James here. My question is, you know, the energy sector is currently seeing a massively strong late cycle rally across the sector, and it's lifting all names, and traders are talking about crude oil projections all the way up to $100. Isn't the reality, though, that oil prices are at $60 only because half the oil wells are open and operational. Wouldn't oil be much lower if the operational wells were at pre-COVID levels?
Well, that's what I was really referring to. Oh, you mean on the Texas crisis? On the Texas crisis, we think the supply has kind of come back. The real issue, which I've referred to, is actually the refining outages, because the wells come back quickly, but the refineries don't. But we're only talking about a matter of weeks. Nevertheless, at this time of year, you should be making summer-grade gasoline, and we've never seen a bigger deficit in terms of downtime at this time of year. So the hurricane season typically, as you know, comes after driving season. What's unusual about the Texas crisis, the snowstorm freeze that we got, was that it's before driving season, and that's why we think there's a refining trade here. But basically, the supply side is recovering much more quickly than the refining side. That's that dynamic. There's a lot of moving parts here.
Paul, put your trader cap back on. And I know you said that these pairs trades were five-year trades, and right now you like the refining part of the oil sector. But if you had your druthers, would you really take off the tech part, short the tech part of the trades, and just go long oil, or is there another short that you would pair against a long oil at this point, seeing how much Apple and Tesla have declined?
Well, if I was really long tech and these very high multiple stocks, I would be terrified by not today's action. Obviously, that was a massive bounce back, but I would be terrified at the prospect of higher interest rates. And let's face it, they're very low. They're moving rapidly higher, but there's potentially a long way for these to go. So I think it's terrifying to be long these ARKKs and stuff like that with such high multiples. Given what we saw over the past couple of months as interest rates began to move higher, it destroyed these stocks. And I don't see, you could argue that we rally interest rates lower, but I don't see why we would. I mean, we all know that they're going to print just a blizzard of really, frankly, unnecessary dollars. Obviously, we're worried about low-income people and people who are struggling, but broadly speaking, U.S. wealth has never been higher. And you're adding another $2 trillion to this pile. That's the super cycle argument. That's the weak dollar argument that makes you bullish oil, bearish tech.
All right. So you're sticking with it, basically. Paul, good to see you. We'll check back in with you. We'll keep you honest on the trade, too.
Thanks. It's always a pleasure, guys.
Thank you. Thank you, research. A guy, he's speaking your language.
It's amazing. I love Paul. I love him more now, obviously, because he is speaking my language. I happen to agree with him. I think, listen, the energy names have obviously had a big run. We've talked about them for a while. I will say the levered names, look at a name like PSX, for example, today. The reversal today from 91 down to 87 is concerning in so much as, we thought they'd stall sort of at the June highs, and that's what's happened. So although I do think there's room to the upside, I think you're going to see 5 to 8% pullbacks on a lot of these names in the short term first. I think the tailwinds that have been there might abate a bit. I think the energy trade still works, but I think lower first, Mel.
Shepard Smith here. Thanks for watching CNBC on YouTube.